Welcome to the Hawaii Housing Report. I'm Patrick ONeill, Principal Broker at Luxury Homes International. And with me today, Hawaii's favorite economist, and might I say best dressed, the illustrious Mr. Paul Brewbaker. Paul, thanks for joining us today.
Disneyland 100. No,
Okay.
Disney 100, I think it is. Whatever they're celebrating. They're all celebrating something.
Okay, I'm glad you're keeping up with that. Um, so Paul, before we jump into the real estate, let's start with a your summarized version of the US economy. Is it good, bad, heading up, heading down? What's your take?
Yeah. Well, we all know the Fed changed monetary policy direction last year pretty abruptly, but not as unexpectedly, for people who've been paying attention. And of course, they articulate everything explicitly. Raised rates really fast up front, and now they're tapering off with the interest rate increases, which will probably continue at least through mid-year in baby steps, trying to find, the top, find their way into the top. And as a result of that, knowing that that was coming and having had our expectations largely fulfilled, seeing some of the disinflation that we would expect under those circumstances, a lot of it coming from reduction in investment demand in the housing segment, we did expect that the economy would be slowing. I've always thought a soft landing was not just the objective of the Federal Reserve, but something, for which they had a good shot of obtaining, of achieving. And it has happened before, and it's important to understand that when it happened before, circumstances were different in a couple of ways. They didn't pre-announce. They started out slow and ended up fast. This time they did it the other way around. Started out really fast and then are now slowing. So this idea that they could glide into a slower economy, slower moving economy with less inflationary pressure or pressure abating, helped along by the reduction in global post-pandemic supply chain and Ukraine war associated supply shocks that the Fed can't control. This idea that the two would come together and we get into this slower moving phase for the economy and disinflation this year and next year still looks like it's going to work out approximately the way we all hope. Now,
And do you think
there's
at this
uncertainty,
point,
and I would say it's like 50-50, that it'll be
yeah,
derailed by some. And of course, it could be derailed by intensification of the Russian invasion in some manner. I mean, there are military risks, and obviously we could get, invaded by balloons or whatever is going on out there. So, things are going to happen that will surprise along the way. But
yeah.
as it is, I think given that employment, the labor market is still really tight, that's not going to change. It's possible we could have a kind of recession-y environment without that much unemployment associated with it. And so for the housing market, it's a matter of waiting for people to be reassured that the risks are abating, that the inflation is subsiding, that interest rates can come back into a zone more consistent with long-term equilibrium,
Mm-hmm.
as opposed to pandemic response or anti-inflation, um,
Right. And for us, of course, mortgage
ruthlessness,
interest rates is what we're
and
most
more
interested in.
and mortgage interest rates getting into a zone that can
So
keep the
this,
housing market
I think
still.
at the last Fed meeting, Chairman Powell said while inflation is decreasing, interest rate hikes are likely. So it
Yeah.
seems that they're going to continue to push that up. So overall U.S. economy right now, the direction, and I've heard you use this rating system before. I think this might have been from the professor at Stanford. I'm not sure where you got this, but it was either ugh or meh or not bad. Where would you put the U.S. economy right now?
Well, better than meh,
Okay, better than meh.
not,
All right, okay.
I mean, 500,000 jobs were created in January. What was
Let's
that
see.
all about?
Okay,
I think that was seasonal. In the winter got really bad at the end of the month, but the labor surveys are done in the early part of the month, and so when you seasonally adjust, the winter that would have made hiring lower wasn't yet upon.
I
The
see.
polar vortex and
Yeah,
all of that stuff.
and the
But
balloons.
more general,
Mhm.
and of course the balloons. But generally, for the US to be generating a couple 100,000 new jobs on net every month right now, that's pretty good for a year in which half the economists you ask anticipate recession and the other half are kind of
Right.
like, really, will it be that bad?
Right. And so talking about inflation, I know that you've said this multiple times. In Hawaii, we're actually below the national average in inflation.
Yeah,
Do you
let's
also
put that.
see it coming down? Hmm.
Yeah, and actually, this is a really important point because let's since I can share, let me show you. On the we talk about interest rates as the Fed's target. That's true, but they're also letting their balance sheet shrink right now. That's part of the plan. It's a more technical aspect of monetary policy making, but basically, when the pandemic came upon us, the the flight to liquidity, right? People start selling stocks and whatnot. Um, and the uncertainty leads people to, go to the safe haven of liquidity. So the Fed literally provides that liquidity to the system by buying securities, mortgage-backed securities, U.S. Treasury securities, and whatnot. They've reversed that now, so they're allowing those securities to peel off, and the nature of the liquidity is shifting from deposits of member banks, commercial banks in the Federal Reserve System to these overnight loans that the Fed provides in the form of reverse repos. So the liquidity is still there, but they're draining off enough of it to be consistent with a return to normalcy for the economy. Similarly, with interest rates, they control the overnight rate. And so that's what you see there. And to your point a second ago, Jay Powell continues to articulate his expectation that short-term interest rates will go up over the course of this year. Well, this is their forecast. This says December. I'm wondering if I updated in January. But either way, we've known this at least for a month or two, and indeed for many months. The Fed's been saying that the overnight rate will get to 5 or 5.25, and here's the range of uncertainty around that because people disagree. They disagree even more. You see the bandwidth widen as to
Timing.
how fast the rate will come down next year
Hmm.
and the
Yes.
year after, not this year, but next
Hmm.
year and thereafter. And as a result, the inflation numbers, right, as the U.S. inflation comes down, validating the success that the Fed was striving to achieve in conjunction with post-pandemic subsidence of global supply chain problems and so on. These longer term rates, right, the 10-year yield will come down
Hmm.
into the high threes, and that will allow mortgage rates to come down. Well, here in Hawaii, where the inflation rate recently wasn't as high, everybody talks about the inflation rate is the highest since 1981. Not in Hawaii. Inflation's lower than in 1981, lower than in 1990, and now it's lower than it was in 2005 or six. So the inflation rate in Hawaii, as of yesterday, this is yesterday's news, and I haven't even seen it on the news.
It's definitely
But
not
urban Hawaii
reported.
inflation
I don't think it's
is definitely not
no
reported.
one wants to hear there's no inflation. Everybody wants
Well,
to
they want to hear that they want to hear. I'm sorry, there's somebody backing up their truck behind me
hear.
here, but they want to hear a number that's scary. And
Hmm.
if not, then they'll move on to, a mass shooting at a school or a scary balloon.
Yeah,
And 5% inflation for the urban Hawaii, measure is not that bad when your goal is 2. I mean, you can just eyeball it and see, oh, well, we'll get there by next year.
I see. I
We might even
gotcha.
get there by the end of this year. You see what I mean? So
I
nobody's
do.
going to talk about it anymore. But I think it's important for people in Hawaii to understand that if you see something that seems really expensive, buy something else because what that's telling you is like eggs are expensive. So now I'm making 1 egg omelets. You know what I mean? Every morning because it's avian flu. It has nothing to do with monetary policy. It has nothing to do with the war in Ukraine. It has
Mm,
nothing to do with the global supply chain. It's
yes.
avian flu wiped out millions of egg laying chickens,
Right.
like
Okay. Well,
all over.
okay. So let's shoot over to mortgage interest rates and have a conversation about that. And I want to bring in someone. You and I always talk about this almost from an academic viewpoint, but I wanted to bring in Anders Hostelley, Senior Vice President at Guaranteed Rate Mortgage here in Hawaii. And Anders, are you there? There he
I'm
is. All
here.
right.
Yeah.
Perfect. Perfect. Yeah. So we want to bring you in on this conversation. find out
Mhm.
what's really happening on the ground. Like what are buyers transacting, what's happening. And just to start our conversation, I'm going to pull up
Sure.
the mortgage rates. This is from Fannie Mae or Freddie Mac. Sorry, Freddie
Mhm.
Mac. We're looking at the 30-year fixed as sort
Yeah.
of our baseline. This was over the past year. Obviously, the big shock to the system in the middle of the year.
Hmm.
Anders, what are you seeing as far as buyers on the ground? If they're transacting buying a home right now, what sort of program are they doing? Is it 6.12 for a 30-year fix?
Yeah, owner occupants, that's right about where, we're seeing borrowers transacting. It's kind of interesting. We're seeing borrowers that are taking out getting interest rates with more points than before, or a little bit like over a point compared to under a point, because they're looking to buy the rate down a little bit so they can qualify, or it helps them to qualify. So we're
Mm-hmm.
seeing definitely more of that,
And,
as
and
rates
what
have
would
moved up.
be, give me an example, 30-year, and I'm going to pay a point. Where do I
That's
end up?
it's right about that Freddie Mac rate. Yeah, it's right around that six, a little over 6%. Then
I see. That's with 1 point.
yeah, yeah, that's right around
Oh,
there. Yeah,
I see.
right around that.
I
Yep,
see.
yep.
And what about adjustable rates? Are you seeing buyers gravitate towards that at all?
Yeah, definitely. There's more interest in adjustable rate mortgages, or like a 7-year fixed for 7 years, then adjust every 6 months thereafter, or fixed for the first 10 and then it adjusts every 6 months thereafter. There's definitely been more buyers that are opting for those types of loans.
And what would those be in today's world? What's the range?
Well, those interest rate wise,
Yes.
yeah, they're in the 5%. Yeah,
Oh, for an adjustable rate. So you're
yeah,
only saving maybe a point
that's
on
correct.
the edge. Oh, I see. So
Yeah,
it's
that's
pretty
correct. Yeah,
close. Oh,
yeah.
very interesting. Interesting. And then as the rates have changed, have the qualifications changed at all? Is it harder to get a loan, easier to get a loan, no difference from
Yeah,
6 months
yeah.
ago, a year ago?
I would say it's really the same underwriting guidelines and criteria. If anything, maybe they've loosened up a little bit. But it's really the interest rate. With rates being, I mean, almost doubling, right, or more than doubled in the last year. That's really what's impacted the what we just talked about, mortgages and mortgage demand over the last year. So, I mean, I was just looking at a graph here, the MBA purchase applications graph, and we're looking at the activity mortgage applications for purchase transactions across the country are about at the levels of about over 20 years ago. So
Wait, can you say that again?
yeah,
This is
so mortgage applications for purchase transactions are at the level of about 20 years ago, 22 years ago.
wow.
which was the start of the subprime bubble,
Yeah, yeah,
2003.
yeah, yeah, exactly. Yeah, it's pretty interesting.
That is really interesting. And you're talking the volume is that low.
Hmm.
How about that?
Well,
Well, that
and when you look at volume, if you look at, well, even when I talk about Hawaii, like Paul and you and I worked at someplace together like
Yeah,
25
yeah,
years ago,
you can
and I
say it.
remember when the median home sales price was in $350,000. So
yeah.
what so when we're talking, like when I'm looking at this is like units, but the average loan amount's a lot higher than it was before, right? So the volume, like the mortgage market is larger, than it was before, but it's because of the average loan amounts have increased.
Yes.
But if you think about the balance sheet, right, the value of the house has gone up too.
Mhm.
So in a sense, we're obviously you're getting what you pay for. But what's interesting to me is that the volume you're seeing is about what it was the last time we were at 6%, which is
Yes,
back
yeah,
in
exactly,
2003.
exactly.
And yet, this is after a 400 basis point increase. If you look at
Mhm.
Patrick's last slide,
Yep.
there's no time since the early 1980s where interest rates went up 400 basis points all in
Hmm.
one fell swoop. So
Hmm.
you can be pretty sure, and that's why when you look at those inflation statistics, you see this as well, that what happened last year was so abrupt and so large that almost certainly it was an overshoot. Almost certainly it went too far. And the question people are asking themselves right now is like, do I lock in for 7 years and then take the flexibility, get the lower rate that comes in the future, or do I wait 6 months in which the rates might actually come all the way? I mean, we're actually looking at a zone from 5 to 6% where mortgage rates could be, playing quite actively for the remainder of 2023.
So let me ask the two of you. I know, Anders, you're looking at this every day. Paul, you do too. Mortgage rates 6 months from now, a year from now. If we're at 6 and some change right now, where do you think we'll be?
Paul, what do you think?
So here's the problem. If we were to rush back to 5% by this summer, we just went from 7% to 6% in 3 months. Let's say we went from 6% to 5% before the summer, the summer season comes. Seems to me that might unleash a little more than we can handle. It wasn't that long ago that we were right, that there weren't enough listings
inventory
to satisfy the demand was there. Now, okay, at 3%, maybe you can understand that. But I think that's why it's so tangled, the uncertainty, because you don't know if by June will there be a recession? Will Russia have invaded? What's going on with that? So, et cetera, et cetera. And I think what you'll find is that the highly motivated buyer, somebody who finds exactly the house they want at exactly the place they want in a zone, when you look at prices, that from a long-term perspective right now are getting back to fair value, right? There was a little bubble after the pandemic as people moved around and remote workers, went to where they really wanted to live. But now we're back on that escalator path. It might be worth somebody just biting the bullet and paying the going rate to get what they want.
That's what I think. Yeah, absolutely.
Yeah. Well, hold that thought, because we're going to take just a real quick break. We come back, we're going to look at pending sales, inventory, and pricing as well. So stand by. We'll be right back with economist Paul Brewbaker and Anders, Guaranteed Rate Honolulu Mortgage Company. Stand by. Okay. Okay, and we're back with the Hawaii Housing Report with economist Paul Brewbaker, and I want to thank Anders Hostelley from Guaranteed Rate Mortgage for joining us and sharing his insights. I hope you enjoyed that, Paul, as well.
Yeah.
Yeah, interesting. And by the way, if you're enjoying this information and you'd like these housing updates, please give Paul a thumbs up down below. It'd really make him happy. And consider subscribing to the channel. Okay, so Paul, when we took a break, we're going to come back and look at the statistics from a Honolulu Board of Realtors. Sales are down, inventory's up. Let me just pull this screen up and we'll take a look at the figures. This is the latest information from the Honolulu Board of Realtors. And let's hit this right here. Okay. So yeah, so we can see now. Excuse me 1 second. There we go. All right. Closed sales down 54% for homes, 50% for condos. We saw something similar last month. And Paul, I went back and took a look historically. What were the 2 years with the biggest annual decline in closed sales? 1991, after the Japanese bubble period, home sales fell 30%. In 2008, after subprime, closed home sales were down 24% only compared to this 50%. Do you think we end this year with a new record?
Well, we could end up back in the -20 to -30 zone only because what you're seeing in January data, -2 months to close the transaction, are what was happening back in November when the mortgage rate was 7%. That's as bad as it got in this recent period. It was much more common, of course, in the 80s, leading into the Japan bubble, if not during all of it. But the sheer magnitude and abruptness and the rapid pace of mortgage rate increases last year created a sudden stop in this drop in sales you see here, minus 50% year over year. That is very similar in magnitude and to those prior events, but was not associated with a valuation bubble preceding the shock that was as intense. And if you recall, we may look at this later, that the single family home prices post-pandemic looked, or after COVID arrived, looked a lot more bubblicious than the condo prices did.
Yes,
So that was another characteristic that's distinguished the market segments.
I was surprised that after the subprime, closed sales were only down 24% on the year. That was a surprising number to me. You know,
well,
now
I think you're probably thinking. I think what we're looking at here, though, is from the month right before mortgage rates started to go up, right? We're looking at a comparison of a 3% mortgage rate and the sales associated with 3%, and a 7% mortgage rate and the sales associated with 7% mortgages. Whereas another year from now, when we look back at 2023 as a whole, all 12 months, just as 2022 for the year as a whole was, is that in here on this slide? These are all January year to date, which is the same
so
as
the
January.
year to date, it'll be the same number.
But my point is that it's going to smooth out a little bit, so it probably won't be minus 50%, but it could easily be minus 20 to 30% for the year as a whole.
Yeah. Okay. And then let's take a look at the other big number here, which is active inventory. Single family homes up 77%. Last month, it was up 93%. This is not really a big surprise. These are big numbers. And I when I put the two together, the closed sales against active inventory, the calculation is this bottom one, right? Month supply of active inventory, remaining inventory. It's up 150% for homes, up 50% for condos. This is my question to you. At 2 months of remaining inventory and 2.4, isn't that traditionally a seller's market? That is
it's still a very tight market. And it does speak to another distinction of the current sudden stop from the two to which you referred in the aftermath of the Japan bubble in the late 80s, early 90s, and then again in the aftermath of the subprime bubble going into the Great Recession in 2008. In particular, if you look at, so here's an interesting statistic because I remember these numbers. Single family home, January 2023, months of inventory, 2 months. Condo, months of inventory, 2.4 months. What were they in 1994, the last time the Fed engineered a soft landing? 20 to 24 months. 2 years of inventory, not 2 months of inventory. So this time is different. It's similar in some ways, in the sense that the abruptness, the suddenness of the stop, the dramatic increase in mortgage rates just cut the thing off like falling off a cliff. 50% year-on-year decrease in sales. But the inventory wasn't excessive going into this period, and it hasn't accumulated enough in 12 months to pile up more than 2 or 3, 2.5 months of inventory anyway. And now interest rates are falling from 7 to 6, maybe to 5%, falling back into a zone where if you think about what the long-term equilibrium is, it's not 3 and it's not 7. It's probably 5 or under. So the thing came upon us really fast last year. It may fade away really fast this year. And at the end of which, if we look at valuations in a moment, you'll probably find that valuations are back on the escalator and mortgage rates are back in a zone where they probably should be, closer to 5 than 4. And there you go, put it on automatic pilot. And as long as the wheels don't come off the economy, the housing market should get back on track with a leaner crew, and you've gone and found some other solutions to lower your fixed costs to deal with you got to stay in business in facing the adversity of the last 12 or what will be 24 months of challenges. But after that, it'll probably look more like a house cleaning than it will like the crash and burn of the early 1990s, or that long period from the peak. Valuations peaked in 2005, maybe 2006, and the recession was upon us 2 years later, and then seemed to just keep the housing market depressed for year after year. 2009, 2010, maybe 2011, the bottom fissures were done, and we sort of got back on track. Now I don't think that's what we're looking at this time.
Yeah. And that's the same kind of experience that we all had in the mid 90s as well. We came off that peak.
In that case, it was the whole decade. I mean, it was kind of the bad hair decade for Hawaii.
Right.
Again, important to note the differences being Hawaii, right?
Yes.
California was having the dot-com tech boom in the late 90s, and Hawaii was just drifting. Like a sitting duck waiting for the black swan of the Asian financial crisis to hit us in 97. You know what I mean? First came the Japan bubble, then came Hurricane Iniki, then came, I don't know, we're doing all this thumbs up and economic revitalization.
That's right.
I remember all this wild stuff. And then the Asian financial crisis comes.
Probably there were balloons then too. That's what I think threw it all off. I read a story today in the paper. It said that there was a Chinese spy balloon flew over Kauai in 2022. I never heard that before. I don't know if that's true or not.
I mean, if what I'm understanding correctly, right, somebody just decided, wow, it's really boring. Let's dial up the sensitivity of our radar systems and see what else we can see. Right. It turns out there's all this stuff flying over us.
That's right. There's spy birds. There's all kinds of things. Hey, Paul, we're going to take a really fast break. We come back. Let's look at the future, pending sales, and then also your take on where prices are headed. So stand by. I'll be right back with economist Paul Brewbaker. Hello and welcome back to the Hawaii Housing Report with economist Paul Brewbaker. And Paul, we're going to jump into some more housing statistics. We'll talk about pending sales and pricing. So let me pull that up. This is the latest data from the Honolulu Board of Realtors. And we start with pending sales, down 15% for homes, down 34% for condos. It's sort of a flip-flop of what we've been seeing, but probably no surprises there, other than it almost seems modest compared to what we were seeing earlier. I think this is either the 9th or the 10th month of pending sales declines. Of course, everything since the interest rates went up. Well, let's take a look at pricing. And I think there's something interesting here. So median price down 7.6, condos down 2.9, modest. But looking back at last January, when we're having this conversation, we're seeing home prices almost up 20%. And if we go back even one more, 15%. And then you did some quick math. And what do you see when you look at these figures?
Well, add them up. Call them minus 7.6 minus 8, and call 18.9 19, call 14.7 15. So 15 plus 19 is 34, minus 8 is 26, which is about 8% per year with some compounding. 8 times 3 is 24, plus some compounding to get 26. That's actually a little high. 8% per year is high relative to the 4 or 5% per year that we saw in the pre-COVID decade. The 20-teens, we saw about 4% annual appreciation for single-family homes, about 5% for condos.
Oh, so when you look at that and you say 8% per annum, just and you're doing this quick math like this.
Yeah, for the last 3 years.
For the last 3 years. Does that suggest to you that prices have further bottom, heading down further?
Yeah, if they're going to get back to the 4% trajectory, 4% over 3 years, which is 12, plus some compounding, call that 14. So, from 24 to 14 is, let's say, 10 basis points. There may be another 8, 9, 10 percentage points of value decline to go to get back to the pre-COVID path. But we can visualize that by just looking at you send me those data and I seasonally adjust them. And so you can kind of see where there's January for single family homes, and there's probably, if it went right back to that dashed line, and then you compared it to 1 year earlier, you see what I mean? That would be,
Mm-hmm.
again, a big-ish decline, maybe high single digit, low double digit. The real question for single family homes is, do they punch through and go under?
Sure
And
looks like it. I mean,
looks
looking at
like
the data, it
looks
looks
like
like it would.
they're diving pretty hard right now. On the other hand, maybe this November number was an anomaly, and you got to worry about the zigzags along the way. In theory, if convergence to this path from the last decade is the right one, and you can extend this path back to the 90s, back to the 80s, it's probably not a bad approximation. You see what I mean? To the
Yes.
long-term path. If you leave out the Japan bubble back here that we just talked about, the subprime bubble back here, we don't think those are going to happen anymore, because as Anders just described, mortgage underwriting is pretty much the same as it was pre-COVID. The only thing that's really changed materially is the mortgage rate itself, but the underwriting standards, the criteria that mortgage underwriters now apply, and that the secondary markets for the securities that pool these mortgages are expecting to, adherence to. Those rules of the game, post financial crisis rules of that game, are pretty solid. They're pretty secure. So we shouldn't see undue influence from bad underwriting as we did 20 years ago, or say extreme offshore investor influence as we saw in the late 1980s. And I'd remind everybody that the late 1980s were also a period of bad mortgage underwriting that we know as the savings and loan crisis. Remember? So
Yes.
if we don't have that source of systemic or sort of fundamental risk exposure in the housing finance system, then the story reverts to just housing itself. And the question is, are these long-term valuations truly an equilibrium trajectory? And if so, could we expect, notwithstanding the gyrations we'll see over the course of this year and maybe stabilizing as we go into 2024, will we see a return to this path, or maybe something slightly flatter, which is indicated if you look at condos? Both single family homes and condos began to ease off this 4 or 5% path in the late 20 teens, about 2018.
Mm-hmm.
And as I look at them unfold now, I'm wondering if the right path is more like 3 or 4% annual appreciation rather than 4 or 5%.
I see.
I
And
mean, who really
Paul,
knows? But
could you go back to that
yeah,
the
you
chart
bet,
that you just had up, the last one there?
you bet.
Um, I know, I mean, I've learned this from you, but when you see these, we'll look at the single family, when you see a market head up and now
Yeah,
searching for that long-term equilibrium, it's
yeah,
going to
coming back.
overshoot. It's not like it just stops there and it goes sideways. Would you
It
expect, when we look at this a year, 2 years from now, we're going to see it dip below, then come back up and bounce around?
Yeah, typically what you see is this phenomenon of oscillation around the longer term trend. So there was a point here around 1998 when a reasonable hunch for a housing investor would have been, you know what, even if I have to endure slightly lower values, this would be a good moment to enter the housing market, 1998. Relative to trend, which I may be under at that particular moment, and with the possibility that I might have some above average upside in years to come. I don't think that the size of this valuation cycle is going to present itself as much as it has in the past. Technically, that's the amplitude of the cycle. You see what I mean? So I don't think there's likely to be as much amplification of these movements around trend from factors that we've seen active in the past. Although one that's notable, the one most recently post-COVID, is this remote work phenomenon that seemed to have
Right.
shifted housing preferences just enough towards the single family, towards the detached housing segment, and away from the urban core environment where more of the condos are concentrated, at least initially. There's just enough of a one-time adjustment in the nature of the workplace. It's over now. People have busted their move. That it created this sort of half bubble, a bubble in one side, a mini bubble in one side, and none on the other side of the market. Now, having become bubblicious in that particular manner, relatively speaking, urban condos are kind of looking like a bargain. And in fact, let's remember, these are resale prices. But as I look around the urban core of Honolulu right now, there's a bunch of nice buildings with not that badly priced condos about to come on market. I mean, I look around, Kakako and up and down the Kapiolani Keomoku corridor, and I see these affordable housing, advertisements in the paper where these capital A, capital H affordable housing. You have to be a qualified buyer, so and so, and such and such. You have to be never have owned real estate before, and pretty much designed for the first time entry level buyer. A studio down on a 400 square foot studio down in Kakako or Kapiolani,
even in Ward Village
corridors. For what, 400,000? That's kind of like, I mean, if you think about it in the long run, if you think about it like Anders was saying, that $350,000 home in 1990, which by the way was $175,000 in 1987, that's 1987, 175, 1991, 350,000, right? Do the math. That's this $1.1 million house today. So if you think about it in the long run, try to get over the fact that 400,000 is a lot of money, and it is for a first-time buyer. Just remember that the whole point is to get on the escalator so that you benefit from the appreciation.
That's right.
That almost surely is going to accrue, albeit, as I'm suggesting now, maybe not quite at the 4, 5, or even 6% rates we saw in the neighbor islands in the last decade. Maybe hope for 4, and in the long run, and then you get to live in your house.
Yes, and I read an interesting.
You can get a CD for 5%, but you can't live in your CD.
That's right. That's right.
You can get a certificate deposit right now for a 1-year CD for 5%, but
plus the tax advantages.
Is that right?
Tax advantages as well.
Not sure that's right. Well, and then you can invest in a municipal bond fund and have if you're older and have tax issues you want to deal with. So the point is, make an informed asset allocation decision. But if you're young and entering the housing market, don't get too freaked out by the prices. Try to get over the sticker shock and think about where things fit in the long run. Houses last longer than people. You should live so long. So
there you
go. Get on the train and see how it goes.
I want to share one other interesting statistic that I saw as I was going through the data. Last year in January, 73% of single-family homes sold at or above the list price. 73%. This January, it was 37% sold at or above the list price. But that's still pretty amazing.
It's amazing that 1/3 of all houses are still selling. I mean, in this market, with these interest rates, people are still listing too low. What?
No, I think if it's priced right, just like any other time, it's going to sell. Okay, Paul, let's move on to my favorite portion, which is the lightning round. We're going to switch. We're going to switch it up a little today. This is going to be a prediction 3 months from now. Okay, are you ready? Okay.
So let's February, March, April. Okay, mid-May.
Mid-May. Okay. Inflation in Hawaii, higher, lower, about the same.
Oh, lower.
Mortgage interest rate.
Lower.
Single-family home prices.
Lower.
Condo prices.
Lower.
Yeah. Let me check. Ding, 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 ding. You got them all right again, Paul. Double bonus points for you.
No, pay attention, people. The summer's housing market, it's not going to be cheap. It's not going to, there won't be bargains, but it's going to be pretty fairly valued if you think about it in any time frame other than the wackiness of the last several years. So,
Hmm.
step back, get some perspective. If it's time to, and if it's that time in your life to make that move, whichever it may be, in and out, sideways, up and down, or what, we may be back to an environment in which it's reasonably priced, you get what you pay for, and you should be so lucky
Yeah,
as often
and rates are heading
this summer.
in the right way.
I
Well,
think it'll
yeah.
be like that. And by the way, if the economy gets worse,
Hmm.
inflation and interest rates will fall by even more. So will home prices.
That's right. That's right. If you're a
So for
buyer,
the
pray
for
for
the
a bad economy.
for the real negative, people who just are waiting for that recession to just slam the U.S. economy. Well, that means lower prices, lower interest rates, and
Yeah.
lower
Yeah. May or may
everything.
not come.
You may
Well,
not
hey,
have a job.
Paul, it's always such a pleasure. And I want to thank Anders Hostelley from Guaranteed Rate Mortgage here in Hawaii for joining us, the information that he shared. Great. Thanks everybody for joining us again. If you enjoyed this information, please hit a thumbs up below. Consider subscribing to the channel. And until next month, aloha.